hello to those that have made some time to join us. Thank you for joining us, folks, for the second of our, I'll call it, market updates with Dr. Andrew Wilson. For many of you, as I look up and see some names that are here this morning, you've attended the first one and some other presentations that we had with, I think it's fair to call an industry leader in Dr. Andrew Wilson, who gives us the unbiased, call it non-clickbait information that's so important for both you and for your clients, both current and prospective. So I thank you all for taking some time this morning. Dr. Wilson's just having a bit of an arm wrestle with his camera, and we'll as soon as that happens, we'll get started. So as I said, thank you all for attending. No doubt a big part of the conversation for today is interest rates, retail spending, and what the rate rises mean for one, consumer confidence, two, retail spending, and where will that be where we start to see the inflation rate start to level out perhaps and turn the corner and come down again. So there's been some softening, obviously, but we certainly need to see some more of it before we see a turn in interest rates. Some fantastic data that Dr. Wilson has that most of you, I'm sure, are seeing on a weekly basis now. I would hope that you've joined Dr. Wilson's LinkedIn page, so you're seeing those weekly auction clearance rates. They're a great barometer of what's happening out in the marketplace more broadly. So as I said, once Dr. Wilson's sorted out his technical issues, we'll then be able to jump straight in and get things sorted. So
yeah, I'm here, Adam. You can hear me okay?
Yeah, we can absolutely hear you okay. We're just not seeing you at the moment.
I think it's your end where the video's not on. I'm happy to sort of talk through it, but I think it's your end where we don't have access to the video. Just let me, while I'm speaking, just check one more thing. Yeah, I think it's your end. I've only been enabled for hang on.
I've just made you a panelist, mate. My apologies. So guilty party is yours truly. So we should find that Andrew, there he is.
No worries, mate. So yeah,
as is the case with all of our business, mate. We make mistakes. We're only human, but what we do across the board is own up to it. So that was entirely on me. I apologise, mate.
No, that's all good. So what I'll do is I'll just share the screen. So we've got to enable me. If you can, from your end to enable share screen, I can get my deck up.
Multiple participants. That should being the operative word, do that now.
Yeah, it's beautiful, mate. So I'll. How
are things in Melbourne town, mate? It's a bit fresher in Melbourne, I imagine, than it is up on the Gold Coast.
Yes, it is. But that's Melbourne for you. It's all our wonderful capitals have their pluses and minuses. And yes. I'm actually headed up to the Gold Coast on Friday, so I'll be looking forward to that just for an event. Okay. So I think we're ready to go, Adam, and I think that's fantastic because we're only a couple of minutes over, and we've got the glitches out of the way. And I can start if you like, because we've got to go through to. We've got to go through to just before midday. And of course, I think we'd like to have some questions, and I'm sure perhaps you've got some things you'd like to say as I go through the deck. So shall we start?
Let's roll.
All right. So thanks very much, Adam, again, for the opportunity to speak today on behalf of the Gallery Group. Of course, we do these as regular market updates with a focus on South-East Queensland. Got some very interesting news today about South-East Queensland, and it's, I guess we could say it's a revival, and it's been a very short period, really, of, I guess we could say, easing housing market activity following what was a very strong boom in 2021 and into 2022. But yeah, markets are up and running again. Focus on that main Brisbane market, of course, and all things really do flow from that Brisbane market to some degree, but we will have the big picture to start with, which is the national market and those drivers that are really have surprised a lot, Adam. in terms of picking up growth this year. A lot of those doomsayers have, got it wrong again. But
once again,
we're getting used to that. But I was just chatting before, Adam, that there still seems to be some sense of pessimism and negativity in parts of the marketplace and from consumers in regard to the housing market. I think they've been sold a pup to a large degree in terms of the resilience and the robust nature of our housing markets, which has been on show again this year quite clearly. And the data will show us those results. But My Housing Market is my brand. I operate as an independent market commentator. We also provide data. I have a number of clients, of which the Gallery Group, of course, is one. And I get paid a fee for my presentation here. So I don't have any skin in the game. I don't have any agenda in terms of product. That's up to Adam to promote what his particular products are, but I'm totally independent in terms of what I present today. And we are all about here the current state and future prospects of housing markets, emphasising that current state, because a lot of what we do discuss in terms of the housing market is based on backward-looking data, but we try to present data as close to real time as we can, and that gives us an advantage in terms of our what I believe is the accuracy of our commentary. So I think if you're a talking head in any particular field, you have to have some qualifications. I have some qualifications, and all in the housing market economics sphere. I also have formal qualifications in research. I'm also a member of the Royal Institute of Chartered Surveyors, which means I have a skill set in measurement. And my measurement, of course, is the housing market and the broader economy. I've also had a lengthy career as a property economist. My last formal role was as chief economist for the Domain Group, but since I left Domain, I've been acting as an independent, and here I am as an independent, and I still get my way around the media from time to time. We had a nice report in the Sydney media, Channel 9 last week, in regard to a reviving housing market there. But I think the media regard me as a bit of a straight shooter and not one prone to exaggerated comments. But we're not here to talk about me. We're here to talk about our housing markets. Capital cities will start with having an overview, their current state and future prospects, and they're all our capitals. And house prices are certainly rising everywhere in 2023. And who would believe if we had said that a year ago, Adam, they probably would have locked us up that in a year's time.
No question.
We're going to start seeing very strong results, despite, 12 increases in interest rates. Can you believe that? But and they're still going, and yet we've shrugged that one off. And our economy and our housing markets are certainly back at full force, and plenty of potential going forward, particularly in our housing markets, because, and I think that's the main point we should mention here, is the value opportunities there are out there for buyers. And that's what is a significant factor in the market, because prices are still lower than where they were a year ago, Adam. And I think that's important to note, that there are those value opportunities in the market, and that's what the market's doing now. It's rebounding and catching up with what it lost last year. So let's have a quick breakdown of the main factors in what's driving our housing markets. And of course, I like to break it down into key areas. On the demand side, people, migration's been a significant factor for the South-East Queensland market, particularly because of the issues with migration. Just have a quick sip. Quick cough. I'm talking too fast. But we had a surge of interstate migration out of the lockdown states, out of the lockdown capitals of Melbourne and Sydney, headed into South-East Queensland. That meant higher prices and higher rents, and it was quite spectacular growth. And now we have, with our borders open, of course, we don't have that same surge from lockdown in terms of interstate migration, but we're certainly getting a surge in international migration. And that means students, and in South-East Queensland, which has a strong education sector, of course, that's going to mean more demand. And the key offset to demand, of course, is supply, and that's how many homes we're building. And we're not building any homes, really. Well, we are, but we're certainly not building enough to catch up with all that demand coming through. Coughing again. And but the glue that holds it all together, of course, is the economy. And we talk about interest rates when we're talking about the economy. And that, of course, is especially important when we're considering our housing market. So let's have a look at the economy and interest rates. Of course, interest rates are important for house price growth because higher interest rates mean properties are less affordable with a mortgage with a given income. And of course, lower interest rates mean property becomes more affordable with a given income with those holding a mortgage. So that puts upward and downward pressure on house prices in response to those change in interest rates. Of course, confidence is also a key when interest rates change, and we saw that last year as soon as we had interest rates rising for the first time in 10 years, more than 10 years. Of course, buyers and sellers, as they do, sat on their hands to wait until there was some clear air. And what happens then, of course, in those circumstances is that pent-up demand is created. And what we're seeing now in our markets, Adam, is the release of that pent-up demand to some degree from those that sat on the sidelines last year. But of course, interest rates are set nationally. We don't have a local interest rate from the RBA. So all our housing markets don't move at the same rate because there are different supply and demand factors and different measures of the local economy, which means that even though they might move in the general direction as rates change, higher and lower, local factors determine the actual rate of growth. And we're seeing that in that Brisbane market at the moment now, which was late to come in terms of the easing in prices last year. The markets were led down by Sydney last year, but Brisbane was still strong into the middle of the year until those interest rate issues started to impact buyer and seller confidence particularly. So the Brisbane market did ease through the second half of last year and into this year, but we're now seeing, Adam, clear signs that Brisbane market is picking up again. And so it's been a very shallow decline, not just for Brisbane, but for other housing markets as well, particularly considering that almost non-stop increase in interest rates that we've had since May last year. So this is our interest rate story. Over the longer term, these are mortgage rates. We had a strong mining boom economic period through to 2007. Reserve Bank was pushing up rates during that period, got up to 9.5%, our average mortgage rate at that period. Just as the market had started to ease, as the Reserve Bank had planned, along came the GFC, the global financial crisis. We were not immune from that. An economic downturn, the Reserve Bank cut rates sharply to stimulate demand. Mortgage rates fell to 5.8%. Australia, unlike the rest of the world, we were saved by our mining boom number 2. Again, we had strong growth, high inflation, interest rates raised to 7.8% mortgage rates through the RBA, trying to quell demand, as they're trying to do now. But at the end of the mining boom number 2, we joined the rest of the world. Down and down, interest rates fell till we got to the official rate of 0.1% during the COVID lockdown or the COVID period, pandemic period. Mortgage rates fell to 4.5%. We had a couple of upticks during that period of falling rates in 2016 and 19, or 18, and that was actioned by the banks to curb particularly investor activity. They were concerned too many investors at that period because they were predicting higher interest rates back then, and that didn't eventuate. In fact, we had lower interest rates. But nonetheless, of course, we've now entered into the COVID period or the post-COVID period of high inflation as a result of those supply roadblocks that COVID created. We've now seen inflation accelerating. Still a big concern for the Reserve Bank. They're worried about now services inflation, which is being driven by higher wages, and similar story in the US and the UK. And of course, interest rates have continued to rise. We've had 12 interest rate increases over the last 13 months, which is unprecedented. But we've got to remember a couple of things. Firstly, it started at 0. So, you know, we've had a lot of increases, but we started from 0. So we had a lot of catching up to do in terms of getting back to the long-term averages. But we can see there that interest rates and, mortgage rates are still, just above where they were back in 2011. So our rates at the moment, our official interest rates are still low compared to the historical average. And I think this is one of the points, Adam, that interest rates haven't had the impact that many had predicted. But I think it's interesting also to note that the banks have actually caught up a little bit in terms of their mortgage rates compared to official rates. So official rates are still the best part of 1% below where they were at their peak in 2011-12, but mortgage rates are actually higher than where they were then. So maybe some insights then into the competition for banks, allowing them to catch up their margins. Now, this is the capital city cycles. You can see how house prices were higher during lower interest rates period, and not so much lower, but eased during higher interest rates period. We can see the effect of those lower interest rates following the boom of 2017-18. We then had markets regenerated through 2019. And then lockdown, of course, eased market activities in 2020 because people just couldn't get out and buy and sell in the marketplace. But when lockdowns finished, there was a surge in demand, that pent-up demand that I mentioned previously, and markets took off, particularly the Sydney market, which was very strong in that period. The Melbourne market, which of course was influenced by more severe lockdowns than any of the other capitals, took some time to get going again. You can see there the gold cycle is the Brisbane cycle. Brisbane was a flattish market during lower interest rate period because of local factors, the flood, the end of the mining boom, previous government. There were some economic issues in Brisbane that resulted in some job shedding, of course, various weather events that impacted the Queensland economy, and the credit squeeze on investors that affected.
So really, to summarise that, Andrew, all markets, I'll use the word dipped as a function of some interest rate rises, but all have now turned and are on the rise again. It's really obviously Sydney, Melbourne, Brisbane haven't yet returned to previous prices. Perth and Adelaide have broken new ground.
That's right, and you're absolutely right, Adam. And I think that's the important thing. When we look at that chart, you can see what's happening clearly. And markets turn, started to improve over the September quarter last year and into the December quarter. It's been a clear revival trend. It's quite, obviously hindsight's great, but we know that because auction clearance rates improved, the rate of decline started to ease. And that we were on track for a revival even in September last year, Adam. And now you can quite clearly see the energy, the upside energy of Melbourne, Sydney and Brisbane. As I mentioned, you can see that Brisbane was one of the last markets to ease last year compared to Melbourne and Sydney that fell away earlier in the year. Brisbane continued to grow to the mid of the year. It's eased through the second half of last year and into this year. And now you can see clearly that the Brisbane market is turning upwards. Now, this is the latest June quarter data, exclusive today for our viewers. This is the data to today in terms of the June quarter. So we're covering most of the June quarter. We've only got 2 weeks to go in June. And you can see that uptick. And I think the interesting thing when we look at the Brisbane cycle there is that it was quite steady through that period of those events that I mentioned, but it still was growing at 5% per annum through that period where there were a lot of roadblocks to Brisbane. And of course, it didn't have the severity of lockdowns that Melbourne and Sydney did, but it did have that surge in interstate migration. And you can see there how the Brisbane market actually grew faster than the Sydney market during that peak of its cycle in 2021 and into 2022. Very, very strong market in Brisbane, but it's been a very shallow decline period for Brisbane, as you can see there, a lot shallower than Brisbane and Melbourne. And now it's back up and running again. And I think that just does reveal the underlying strength and affordability of the Brisbane housing market, Adam. And it's clearly revealed there in those charts. So I think that's the important factor. And you're absolutely right that what it's revealing, it's on the upswing, and yet it's still below its peaks of a year ago. And I think this is the value equation that is driving buyers into the market. They say, well, look, there's plenty of buying going on, but I'm still buying at a discount to what it was a year ago. So it's good value going forward and that's why capital growth is in that catch-up mode, which is very, very similar to what we saw in 2019 when markets...
I'd be interested, Andrew, for next month. I appreciate we're talking about the market more broadly. certainly what we're seeing on the ground is that there's I'll use the phrase a hangover from the party of home builder, the boost.
Yes.
So that retail buyer, our numbers suggest that there are about 3 years worth of land sales that took place in about 12 months. So that pull forward has seen a lull in the last 6 months. Combined with interest rate rises, there's been a lull in retail land sales. So for the mum and dad first home buyer trade up market, that market has softened. We're being told now by the Stocklands, the Lend Leases of the world, that there's some fresh buds starting to bloom in that space. I can say certainly from an investor perspective, our sales activity and our inquiry, because that's the market that we're in, is very, very strong right now. I think driven around vacancy rates.
Yeah.
So I think I'm interested to get your take, and I'd like to talk about it next time. Is I have this feeling that as we see that mum and dad buyer come back into the market along with the investors, we could well see another surge in terms of land prices.
Yeah. Well, that's what we've seen historically, Adam, and that's the point. And you can see that chart for Brisbane is now turning up, and that's that buyer you're speaking about. And we'll look at the latest auction data for Brisbane, which again is supporting the revival in the Brisbane market. And this has really gathered pace over the last 2 months, 6 weeks or so. So that's our interest rate house price story. We've got a lot to cover, so I don't want to get too deep. And we'll look more specifically at interest rates now, Adam. Another rate rise announced for June by the Reserve Bank. It shocked us all a little bit with that April pause. Perhaps they were a little premature with that. But the numbers were still strong in terms of our economy. But I think they've changed their narrative to some degree in their latest decision in June. But no real surprise that rates were raised in June. 12 increases since May 2022. Perhaps some early signs, Adam, that which is good news, that the economy may be feeling the pinch from higher rates. The labour market was a bit weaker over April, and so were retail sales. If that trend continues, I think that the RBA will likely act to pause rate rises sooner rather than later. But inflation is the key. The Reserve Bank was very clear in its commentary in regard to its decision that it was concerned about inflation. And in a sense, it's probably hardened its stance somewhat. But I just want to mention that the US are having their decision today in terms of their interest rates. And there's a lot of chat now. In fact, the markets are almost convinced that the US will pause for the first time in this cycle its rates for June. Its latest inflation data, which was released this morning, has shown some easing in inflation, which was expected. So there wasn't an increase in annual inflation in the US. So if the markets are right, and we don't know, then this pause will obviously set the scene for the sense that, it's the first pause. So maybe this reflects the fact that the US is now reaching the peak of its interest rate cycle, and that may work its way through into decisions that are made by Australia. So some good news there in a sense in terms of the outlook for interest rates.
Question mark around I'll use the word correlation between US rates and Australian rates. Andrew, is there any connection between the two when you're looking at rates in the US, or are they absolutely disconnected in terms of rates activity?
Well, they're disconnected because there are different factors that affect the markets or affect the economies differently, because markets operate differently between the US and Australia. But it's no coincidence that we're seeing the same trends, and these are the post-COVID trends that we're now seeing, which are similar. We had high inflation because supply couldn't keep up with demand with the stimulus packages. Now we've seen supply catching up with demand. Unfortunately, we've seen high wages as a result of inflation. Workers are bidding up their wages. And that means that not just goods sector, but the services sector is putting up their prices to cover those higher wages. Now, this has happened in the US and the UK. It's happening now. And the Reserve Bank has, coincidentally to your question, has actually mentioned the fact that it's seeing these service cost outbreaks impacting Australia now, as it's impacted other countries. and that it's concerned about that. So it's sort of hardened up its stance. But I think when you look at that comparison between where our rates are now and where they were at the peak of the previous cycle, we're still, as I said, the best part of 1% below that. So, maybe we're going to peak out at around about that same rate where we were before. And I think this is part of the story, that in terms of the historical experience, our interest rates are still quite low, Adam, going forward. So this is what the Reserve Bank said in terms of its statement when it released its interest rates. Inflation in Australia has passed its peak. 7% is still too high, however, and it will take some time before it's back to its target range. Its increase in rates is to provide further confidence that inflation will return to target within a reasonable time frame. Recent data indicates the upside risks to inflation have increased, and this is concerning the Reserve Bank. Goods prices is slowing, as I mentioned, because of the adjustments now from COVID, but services prices are still very high and proving to be very persistent overseas. So that's our connection with the overseas model. And unit costs are also rising briskly, with productivity growth remaining subdued. And what that means is that because prices are high, workers are asking for more wages, but there's not the productivity there to offset the increase in wages that employers have to pay. So how do they keep their profit margins? They've got to put up their prices. So that's the problem the Reserve Bank has. I think they hardened their stance in terms of inflation, but the numbers coming out of the US, perhaps if they do pause and the inflation numbers are looking more positive, even though, as you said, Adam, there's not a direct correlation, but it does work in the same mechanism. So I'd be surprised if the US inflation experience, which is based on those high service costs, as well as the adjustment of COVID, isn't something that we match here in Australia. And we're a little bit better off in terms of those rising wages, because unlike the US, we typically have those annual or even 2 yearly wage reviews. So our wage issues are a little stickier, I guess you could say, than we see in the US and the UK. April inflation, just quickly, this is what the Reserve Bank was referring to. Annual inflation was up from 2.2% to 6.8%. So it was concerned that annual inflation increased. Higher fuel costs were contributed to that annual rise. Underlying inflation was down, and that excludes volatile items such as food and fuel, was down to 6.5%. But it's still well ahead of the 2 to 3% target that the Reserve Bank is looking to meet. So some work to do yet. But the most significant contributors to the latest inflation data were housing. Of course, we know rents are very high, and building costs for houses are falling marginally, but still high. By falling, I mean their rate of increase is falling. Food, transport and recreation were the main contributors. When we look at the big picture for the economy, and we'll just run through this quickly, still a very low unemployment rate, even though the unemployment rate did pick up marginally over April. Our capital cities are still quite low. Brisbane just a 3.8% unemployment rate. These are the lowest unemployment rates, Adam, we've seen since the early 1970s. So let's put it in that context. It's a remarkable economy. Everybody's got a job basically who wants a job, and wages are rising at the fastest rate in better than 10 years. So yeah, the jobless rate up slightly, but still near record low. We did have lower jobs. Jobs fell over the month, down by 4,000. Unemployment numbers were up by 18,000. Participation rate, that's the proportion of the population in the workforce, was just down a little bit. So fewer people out of the population working, but still near a record high. All capitals are still reporting very low unemployment rates. And really the rate increases had no significant impact on the real economy, and that's the labour market, which is what what stops us spending is when we start losing our jobs. So still some work to go there in terms of having an impact on our employment. And as long as we have higher wages and everybody's got a job, we're going to have people out there buying houses and being active in the housing market. It is that strong economy. But, maybe the first sign that our economy is starting to be affected by those higher interest rates, which is a good news story, particularly given the economy is still really strong, because it may encourage the Reserve Bank to pause over coming months, although there are signs that it's really focusing on inflation rather than the labour market. Retail sales were flat after growing quite strongly. Another sign that maybe higher interest rates are working. So we had a flattening of retail sales over April. Another sign that higher rates are working, and wages, as I mentioned, are still rising at the fastest rate in over 10 years, and are going to get very close to 4%, I think, when we get the latest June.
I read this morning with interest, Andrew, David Jones came out and announced their turnover forecasts, and I think at various key locations, and they looked like they were about 20% down in terms of revenue in David Jones. So it sounds like retail's starting to come off.
Well, it's coming off from an amazingly high base, Adam, and I mean it had to happen. You know, the spendathon has finished. The COVID stimulus spendathon has finished. It had to finish sometime. But if you look at those retail numbers, you can see that we're still well ahead of a year ago. And look where we are compared to pre-COVID. We're massively higher than the pre-COVID. Of course, inflation has something to do with that. It had to happen, and higher interest rates, of course. But this is the plan from the Reserve Bank, wants to stop us spending to get inflation under control. So just quickly, I've already mentioned population growth as a factor in our housing markets. We're seeing a big rise in overseas migration. You can see the turnaround once lockdown's finished. Queensland's still tracking, and this is backward-looking data, September quarter, so it does reflect that surge we had out of southern states through COVID, but still ahead. We'll get the latest data out this week, actually, Adam. So we'll see how that's
very strong for Queensland on a per capita basis, isn't it?
That's right. And where are they going to live? And of course,
pressure.
Upward pressure on rents and housing. We've already seen New South Wales is leading the charge for net overseas migration, the latest data, and Queensland, of course, still reflecting the COVID period, is the highest for interstate migration. On the supply side, we had house building's been a disaster in Australia, lower again over April, units down particularly. However, Brisbane's been the top performer over the past year, up by 3.5%. Other capitals, however, are down significantly. And this is part of the story with our housing markets, not just the revival and the value perceptions, but we've just run out of houses and units. And that's what's particularly affecting our rental market. We'll have a look at that data shortly. You can see how the trend is clearly downwards on home building nationally. And you can see both units and houses are trending downwards clearly. And we're not just providing the supply with particularly that surge in migration coming through.
When you look at some of that data, Andrew, I can speak sort of at a local level on the Gold Coast. We know that there's about 80 apartment sites that have got what I'll call hoarding around their sites at the moment as potential apartment sites. We've actually sort of dived into the detail on that, and we, by our estimations, about 35 of them, whilst they're planned to be developed, we've looked at the revenues that the products are being sold at and today's construction costs, and we think so almost half of those projects that are planned and have been approved, so go to the supply side, will not actually result in delivered product.
And that's absolutely 100%, Adam, and that's the problem. Not only the issues that Australian construction faces, which it's systemic issues of planning constraints, red tape, green tape. They've now got the big one, which is high building costs. So it's going to mean that all these approvals, which are terribly low anyway, the proportion of those approvals, as you mentioned, that become actual commencements is going to be the lowest on record. And, because builders can get the approval, which is hard enough, but then they've got to think, okay, can we make money out of this? And this is the problem. So it's going to get even worse. And Australia, which is probably run out of housing now, is going to get, chronically undersupplied, for a long time to come. So it's only going to mean higher prices and higher rents, and some real issues in terms of society's adjustment to these problems. And they really can't be fixed in the short term, maybe even in the medium term, Adam. And as we see with those with the data, the national data compared to the longer term or the medium term, it's significantly well down. And that's the long-term trend there for housing in Australia. You can see it's still well below its peak in 2015-16, and particularly for units there, you can see how units have fallen away quite sharply. We had the surge. The black chart there is the surge we had from home builder, the policy from the previous government during COVID, the stimulus policy, but now we're seeing trending down below now the longer term peak trends for house building. So it's a very tough story, and really there's nothing we can do about it, and just got to get used to it. To becoming that housing has become even more of a premium asset, in our society, and the numbers won't lie, particularly where we're seeing hundreds and hundreds of thousands of people coming into Australia to live. So, we don't have enough for our existing population, much less the surge from outsiders that are coming in, and that's not going to change. So over the year, we can see Brisbane's been the top performer the year to date compared to the same period last year. And when we look at the comparisons, Brisbane was actually tracking a little bit higher than Sydney. Those Sydney's numbers are disastrous compared to the long-term trend, but Brisbane's been actually matching Sydney. And even though Brisbane's undersupplied, you can just see what the problem is in Sydney, which is basically run out of land for a start. But it has even more constraints to its new building. But Melbourne's still the leader there in terms of supply, and that maybe helps Melbourne have a better performance in terms of rents and prices compared, particularly to Sydney.
I think one of the challenges for the South-East Queensland market, we've obviously got what's called Economic Development Queensland, where they're focusing on some key areas where they're looking at some future land supply. I'll use Caboolture West as an example, where they're saying there's going to be 55,000 homes provided, but those 55,000 homes are across 3 developers. So it's a simple fact that if you look at the largest project to have rolled out in South-East Queensland over the last 20 years, it would be Springfield Lakes in the Western Corridor. Yeah. And at their peak, they delivered 1,030 lots one year. So you can talk 50,000 as a future supply. The timeline to deliver that will actually be over 20 years. Yeah. So the solution doesn't come.
No, it's really a disastrous environment, Adam. And as I said, I don't think there's any real solution, and governments don't have solutions either, other than just sort of nibbling at trying to offset those that are marginalised to try to provide them with housing. So let's have a look at the latest housing market insights. The rents are a horror story. Look at that, Brisbane house rents up 33.7% over the past year. The latest data over May up 0.8%. A vacancy rate of just 0.4%. That's crazy stuff in Brisbane, but they're not alone there. And when we look at units, units up 1.8% over the month. Unit rents $560. Brisbane unit rents are higher than Melbourne, and Brisbane unit rents up by 24.4% over the past year. So again, and they're not coming from a low base, whereas Melbourne and Sydney were. That's why they've had that very strong increase. So very, not good news there for tenants in Brisbane, but certainly a good news story there in a sense to offset those higher interest rates for those investors or landlords that have a mortgage. At least they're seeing some very, very strong results in terms of rents. I'll give everybody 10 seconds. How's that? Or 20 seconds. They can copy our latest rent report on that QR code. So just get your cameras out. Have a quick picture while I just have a breath, take my breath, and in 30 seconds we'll be back.
Guys, if there's ever an opportunity to give information to your clients, both potential and current, around South-East Queensland and why invest in South-East Queensland, that's the report that you should be giving to them. You can either give it to people in full, or you could grab some screen grabs and different pieces of it and give them some excerpts. Please make sure that you reference Dr. Andrew Wilson. It is really valuable information, so he's entitled to be referenced. But I would say there's some stuff in there that for anyone that's looking to invest, there's some secret sauce there that if you give that to your clients, it's the reasons why to invest in South-East Queensland. It's just, all you need to do is recycle it, and it's fantastic stuff.
Thank you, Adam, and we'll move on. I think everybody's had we'll have another opportunity to look at our house price report as well. So keep your cameras handy so we can have a look at that as well. So home prices, we'll just have a quick look at last year, and we won't delve into too much. There was a lot of negativity about what happened last year. In fact, it was only Sydney and Melbourne where house prices fell. Better than the 30% off predictions, though. That's right, mate. Well, it's crazy stuff. In fact, units outperformed houses in Brisbane last year, up by 11% last year, unit prices, and it was only against Sydney and Melbourne where prices fell. And when we can look at the past, the 2021 versus 2022, when you put them all together, we can see how strong the price growth was over that 2-year period, 34.6% growth in the Brisbane house prices over 2 years. We had those predictions, as you mentioned, Adam, but the reality was that we've only had 4 years of house price decline since 1987 in Australia. So that says it all. And so far this year, we're up 3.3%. So that's the real story. So all those predictions of house price crashes are not based on the history, on history in any way, Adam. And that's all that data. And certainly we're looking to, excuse me, looking to have positive growth this year. So the latest data, latest home price data, housing markets are rebounding. All capital cities are rising. We've had 4 consecutive increases in the national house price up to the May quarter. So that's the May quarter, the April quarter, the March quarter, February quarter. So we measure on a rolling quarterly basis, which is very robust. It gives us lots of observations. So it's a very steady and reliable measure of house price activity. Monthly data tends to have lower observations. And of course, if you take the set quarters, you've got to wait 3 months for the next data. So I think this is a very robust and reliable measure for housing markets. And we track over 100,000 sales every week. So in terms of an aggregate measure. So there's our 4 consecutive quarters of house price rises. Brisbane up 0.6% over May. So it's continuing to rise. Up 1% this year so far in revival mode, but still down 4.7% over the year. So some good value opportunities there in Brisbane. National unit prices.
Sorry, if you could just think, sorry.
Yeah, no
and just back one page. For me, the most telling numbers there is Brisbane, we'll call it South-East Queensland pricing when compared to the traditional properties, the locations that people invest in, Melbourne and Sydney. Yes. We're at 75% of those prices, 70 to 75% of those prices. With interest rates as they are, how does an investor, a traditional investor, invest in Sydney or surrounds? It's very, very challenging indeed. And there's certainly been activity in both Adelaide, more so than the Perth markets over recent periods, with Adelaide now sitting effectively at the same prices as Brisbane. So I think Brisbane personally is poised to see another run.
Yeah, that's right. And that's what we're seeing with that latest data. And of course, we saw that rents in Brisbane are higher than rents in Melbourne. So you're getting a better yield as well. You know? Yeah. So the yield is always that important factor in terms of an investor return on investment. Unit prices still increasing. National unit prices up sharply in May, similar results. Brisbane unit prices just eased a little bit, can be a volatile measure over the month, and we'll look at the latest June data, which gives us a better result there for Brisbane. Of course, this is May national data, but over the year, Brisbane up 1.6%, the full year at 4.6%. So unit prices are higher than where they were a year ago. So these are Brisbane house prices up to today, Adam. So this is the latest data with the June quarter. What we saw before was the comparisons with the May quarter data. So the June quarter data, and this will be very close to the mark when we get the final data through at the end of the month. Again, another rise for Brisbane. And when we look at the unit market, we can see that's bounced back after easing over March. So the unit market and well ahead of where it was a year ago, units, Adam, in Brisbane. So again, we're now seeing a revival in our housing markets, 4 consecutive months, the national price growth. Prices are still generally below where they were a year ago, so there's still some good value opportunities there. Unit prices are also higher now over 4 consecutive months. Most capitals report higher unit prices over May. And capital city markets are certainly primed to continue to rise over the remainder of the year. And of course, we're moving into the winter markets, which can be a little quieter, not necessarily the Brisbane market, which tends to move all the way through as quite a robust mid-year market, but certainly the spring revival is still to come, and or the spring selling season is still to come, which will continue to activate the revival so far. And Brisbane housing market is now clearly reviving, following a really brief easing, as we saw before with the cycle. I don't want to rub this in, but we've had a few of them that were wrong about house prices. So I'll just put that up. And obviously the Reserve Bank said, yeah, okay, it's not going to fall as much as we predicted. And the ANZ was one of all the banks that always predicted that predicted these terrible declines. And now they're saying quite clearly that it's not going to happen. So be careful who you listen to when you're making your decisions on property, Adam. I think that's the lesson here. Now, if you want a copy of that housing market or the full housing market report, get your cameras out. I hope you've all got them handy. Take a picture of that and it'll give you full details of the May quarter housing market activity. We're sort of coming towards the end of the presentation now.
Once again, guys, great opportunity to use the data, but please give Andrew the courtesy of referencing where it's come from. One, it's the right thing to do. Two, it's a smart thing to do because it's third party. It's an industry leader, non-biased view, so it gives the data credibility.
Thank you very much, Adam. And we'll move on because we've got one more for the full presentation today. We've got another QR code you can look at because I've got a raft of South-East Queensland data that I'm not going to go through because we'll run out of time. But I firstly want to look at our forecasts for this year. These are my forecasts for our, whoops, well, one of them hasn't come up. Anyway, that's all right. So Brisbane up 5% this year. Now, these are mid-price range forecasts. The Sydney one has disappeared for some strange reason. But that Sydney, I've got forecasts rise by 9%. Brisbane units, I believe, up 8% this year. These are mid-range forecasts, so I think this will be in the middle of what we see. But I do think that the bias is on the upside for Brisbane. So I think that if there's any risk to these forecasts, it will be higher. In other words, I think they could land higher rather than lower going forward. And we've already had a good start to the year so far. Now, I've got a full data set here for the Gold Coast. I'm not going to go through this in any detail, but this is the latest data up to April for the Gold Coast, and it covers house and unit prices, the changes. I've also got the top suburbs for performance up to April, the end of April actually, for suburbs with their rental data and their yields. Similarly for units, the top performing suburbs for units on the Gold Coast, the rental data for the Gold Coast for both houses and units up to April. We'll be refreshing this data in time for our next presentation, and also the change in the Gold Coast rents over the past 2 years.
Look at those yields. Look at those yields. That's right. So 5.1%.
This is the yield chart for houses, and this is the yield chart for units now at 6%. So, reflecting those high rents and that easing in price recently. But as we can see, prices are now starting to rise again. Dwelling construction on the Gold Coast, similar to the national story, is down from its previous peaks. And you can see those long-term trends. Houses have picked up, but certainly it's problematic in terms of units on the Gold Coast. And this is the historical change. Migration, this is the Queensland migration story, which we've already seen, which is positive for the Gold Coast and other South-East Queensland regions. And you can see that spectacularly low unemployment rate, 2.7%. Can you believe it? On the Gold Coast compared to 4.5%. So I've also got the same data for key locations that Adam has requested. One is Toowoomba, so we won't go through that. I'll flip through till we get to our other key South-East Queensland LGA, and that is Logan. So you can all get a copy of this and forensically look at the data for those regions when making your decisions. So we're going to finish off with the weekend auction market activity. We can see a strong result which was a holiday weekend in most capitals except Brisbane, but still that clearance rates are now rising. 73.8% is very strong for Brisbane. It's now getting back to where it was a year ago, which was a very strong market. So very positive signs there for the Brisbane market in terms of its weekend auction markets. And you can see there that Brisbane is now tracking higher than where it was a year ago in terms of its clearance rates. And you can get those weekend clearance rates on my LinkedIn channel, which is Doc Andrew Wilson. So auction markets certainly ended the month with more healthy results. Most sellers with markets primed to continue to rise. So just finishing up, what I'll do is I think the important factors in terms of what we've done today, and Adam has alluded to it, is to make sure that you're relying on data and commentary that's based on hard data, real-time data, because misinformation and ignorance still remain the curse of Australian housing markets. I'm still bemused that there's still a sense out there that housing markets are under pressure, that prices are falling, that there's a crash that's imminent, and yet we've had 4 months of rising and strengthening data. It's not just the price data, it's other data, a model such as the auction market data, that is clarifying that this is a reviving market. It's a good market for buyers because they can still buy at a discount rate from a year ago. We do have the potential for perhaps sooner rather than later interest rate rises to start to ease. Perhaps we'll get some leadership from the US on that this week. But I think that there's no doubt that there's no questions about the fact that our housing markets are reviving, and that the key factors for our housing markets are there to stay, and that is more demand and less supply. And you only have to look at the horror story in the rental market to confirm that. This is the toughest rental market we've had in our history, really. And I'm always bemused that governments aren't looking to one solution, and that's to create more incentives for investors to get into the market and provide private dwellings.
They're in fact doing, as we all know, looking to do the opposite right now, coming up with a grand scheme to do the exact opposite. It's bizarre.
But that's only going to end up with cardboard suburbs, let me tell you.
That's exactly right.
Because we need more investors, not fewer.
Yeah.
Because the plan to replace the investor with the first home buyer, it can't work. Yeah. Particularly with rents going through the roof. And it's not going to change, because rents will only go higher if you disincentivize investors. Yep. You need to give more incentives to investors. We need urgently more rental properties. You can't fix it. Governments can't fix this by building their way out of it. They can't afford it. And there's just too many houses that are required, or units that are required. And the barriers are just insurmountable to getting the sort of numbers that we need. You need to incentivize the private rental market sector for landlords and investors. Not think, okay, if we get rid of investors, then everybody will be buying the investor house. No, you're just going to have fewer investment properties if that occurs. And the transition between someone trying to get into the market, particularly with prices rising now, so it's becoming less affordable for a first home buyer, regardless of the incentives they've got, because A, prices are rising again, and B, rents are, they've got to save in this terrible rental market with rents going up sharply. How do you save, your deposit to get in? And that's always the problem with first home buyers. So
I think the great challenge in terms of supply and government, I attended a state government launch of their NAIF, a fund that they're looking to encourage private developers to help with supply. I attended that, and they're looking at areas such as in the north of Brisbane, in Chermside, Mount Gravatt, and other areas that are, I'll call it, fringe suburbs. We know through our experience that unless you're achieving at least $13,000 a square metre for an apartment site, irrespective of how much you might pay for the land, you cannot make that project work and make it profitable to get funding support from a bank in the market that we're in, with construction cost increases as they are. So those areas that they're talking about wanting supply, there is no land supply for apartments. So they're simply looking for something. They're looking for a pot at the end of the rainbow that's just not there.
No, it's in my opinion, certainly in the short to medium term, it's an insurmountable problem, and we'd have to have another lockdown, borders shut to even that wouldn't make any difference, because even during lockdown we were suffering with our rental markets. It's just undersupply, and it's something that's been coming for a long time, Adam. This is paying the piper now for all those planning restrictions, the red tape, the green tape. It's now creating this, almost a disaster in terms of accommodation. But misinformation and ignorance remain the curse of Australian housing markets. We know that again, except for those that rationalise and act on the fear it generates. And that's what we've tried to do today. And that's what we always try to do through my presentations in the gallery group, is that you can make informed decisions. And I mean informed decisions based on the latest data and rational insights. And of course, in terms of the housing market in Australia, there is nothing to fear but fear itself. We saw the long-term chart there in terms of downturns. It just doesn't exist. What this, the agendas for these that make these ridiculous predictions, they should be held accountable at some level. But, we all move on and they just say, okay, well, it didn't happen this year, it'll happen next year. And how do you get around that? Yeah. So there is nothing to fear but fear itself. And hello, Adam, we've proved it again this year. Here we go again, right? And like I said, the only get out of jail card for those that are the clickbaiters looking for crazy headlines that don't come true is that, oh, well, it'll happen next year, you wait and see. And of course, those that buy into that, they miss out. You snooze, you lose. And those that are still buying into that fear factor are going to miss out in terms of properties, which are clearly now starting to rise in value again. And that's the story we always are used to in Australian property market. So demand is ahead of supply, confidence is reviving, and prices are now on the rise in 2023, particularly in South-East Queensland, which has had that remarkably short easing period following that strong boom that was into the middle of last year, and prices are rising again in Brisbane.
One thing we are certainly seeing at the moment, Andrew, is with the universities in the fringe corridors like University of Southern Queensland out in Springfield, New University in Moreton Bay, in around Strathpine, those would have been regional areas without a lot of that student accommodation requirement, where it's not actually being produced as student accommodation. We're seeing a lot of our rental product in the likes of Greater Springfield, in Moreton Bay, being taken up by those students that are moving back to Australia to have to, in terms of completing their studies domestically rather than offshore. So it's my view that with that, again, compression of supply, we're going to see a huge demand surge for that accommodation. I think that we could see, particularly in those outer areas, rents increase as much as, my view, is as much as 20% over the next 12 months.
And the thing with rent increases is there's no restrictions, Adam. I mean, you can pay, you can pitch the highest rent as you can, and the landlord's going to say, yeah, right. And now it's different to banks. When you buy a property, you are restricted in terms of your borrowing capacity. You're not restricted in terms of your rental capacity, and a landlord will take obviously the highest rent they can, particularly, obviously they want a quality tenant as well, but particularly when you have so much choice in terms of that particular tenant. So, and governments can't start creating environments where you're having rent freezes, because you have to realise these are private sector businesses, and if you're restricting income, you then have to offset the expenditure side of the equation.
Absolutely.
You can't be saying, oh, well, you can't get as much rent, but you've got to keep paying higher interest rates. Sorry, you can't do that. That's going to end up in a court somewhere, and governments are going to look loopy. Now, it's all right for the fringe political parties to push these things out because they sound good and they're simplistic, but they're never going to be activated, and the government wouldn't last 2 seconds. And as I said, you're just creating the environment for cardboard suburbs if you continue to do this. So let's hope the governments are a little bit less looking to the politics, but looking at in the short term, but looking to what the consequences could be in the long term. And they're already pretty bleak at the moment, Adam. Shall we take some questions, or have we run out of time? I think we have.
We're probably light on for time. I think if you can, any questions, guys? If you've got any questions, we've got just 1 or 2 minutes that we can give. We're right on the clock, so it's probably, in fairness to you, Dr. Wilson, I know you've got plenty to do down in Melbourne town. I know you're off to do something else very shortly. We don't want to have you late to your.
No, that's all right. All good.
Your next presentation. I think for next time, I think the more we can drill down on South-East Queensland, you and I might chat about that some more in between. But I think takeaways for me. The market didn't dip as was suggested. That's absolutely clear to me. With migration and immigration, with some big numbers with South-East Queensland, we saw 81,000, higher than both New South Wales and Victoria. That that puts upward pressure in terms of rents. So, and we're seeing that in our business right now with our real estate business, and despite what the Greens might say, our rental business has a responsibility to our landlords. So we're seeing some great opportunities, quite frankly, to go back to tenants and increase the rent. So as I said, internally, I'm of the view that we'll see at least 20% rental increases in the next 12 months. So really, really strong yields. Obviously, with the changes to South-East Queensland, one of the policies that I'm pleased about that Anastasia and the government did was relaxations around auxiliary dwellings being allowed to be rented to unrelated parties. So we're putting some of that product through back out into the marketplace in all of the corridors, along with our co-living. Really gives our investors some insulation, if I call it that, in between interest rate rises and what we're achieving for rents. You know, we're getting some extraordinary rents in, you know, the likes of Moreton Bay, Ipswich, Logan corridors now. You know, $1,000 a week for a co-living property that's $750,000. The numbers are truly phenomenal. And whilst the Brisbane vacancy rate is 0.7%, I think it was, the gallery vacancy rate is 0. That's so awesome. It is just extraordinary, particularly in that affordable end of the market, which is where we tend to operate for our investors. I think it's a huge opportunity now. We know that input costs are going up for the delivery of both land and building, so prices are going to increase.
Absolutely, and we're seeing we don't have to speculate on that being a possibility. We see it happening every day, and those rental numbers are just remarkable. They're unprecedented, and there's no relief in sight. So, you know, housing is only going to become an even more, you know, premier asset in the Australian context, particularly, you know, and, you know, you wouldn't want to be renting.
No. Well, once again, Dr. Wilson,
my pleasure.
Firstly, information that's real. It's not headlines. No. It's actually up to the minute. And we thank you so much for your insights, and look forward to doing this again next month.
Yes, and we'll have the full spectrum of South-East Queensland LGAs to look at. So we'll work our way a bit quicker through the national, and we'll have a deep dive into our major LGAs in South-East Queensland to see how they've tracked over the first half of the year.
I'd love for us to understand a little bit about infrastructure spending on a state-by-state base, if there's some data that we can tackle. You know, when you look at what's happening in South-East Queensland, the infrastructure that's called pre-Olympic infrastructure is just phenomenal on the ground.
Absolutely. Good one, Adam. Thank you very
Fantastic.
much. Thanks, everybody, for attending, and all the very best for your property decisions going forward.
Thanks for your time again, Dr. Andrew Wilson. And thank you all for attending.